Let's get back to that NFP report that we got this morning. It pointed to 130,000 jobs that were added in August, missing economists' expectations of 160,000 jobs. The unemployment rate holding steady at 3.7%. All of this coming as manufacturing has been among the weakest performing sectors, with just 3,000 jobs created last month. And that is less than half the number we saw just 2 months ago. Joining us is Dan Mitchell. He's chairman of the Center for Freedom Prosperity. Dan, always good to talk to you. So we got what was weak numbers that were weaker than expected, and yet we are seeing the market continuing to stay in the green. So what do you think is kind of feeding into that optimism? Is it just the expectation that as a result of these numbers, the Fed is going to move forward with that rate cut later this month?
There probably is the expectation of a Fed intervention, but I also think that the employment numbers are better than people are portraying them. We have pretty good data on wages. We have pretty good data on labor force participation. And let's not forget, this is the longest economic expansion we've had in our history. So there's a lot to like. I mean, not like it's a great report, but a lot of countries would love to trade places with us.
So not a great report, but as you point out, it's not all doom and gloom, as some have suggested. I mean, you look at some of the silver lining that we can pull from this, hourly wages going up. One of the weaknesses we've seen has been in manufacturing, but also the services sector. It was at 196,000 just a year ago. August, 96,000 jobs. So how do you kind of balance, how do you weigh the good with the bad?
Well, the first thing I always do is I try not to read too much in 1 month of numbers. Maybe they'll be revised. Maybe we'll see 2 months of good numbers that are following this, or maybe we'll see 2 months of bad numbers. So 1 month or 1 quarter of economic data, always be a little bit guarded in terms of making sweeping proclamations. What I will say is, from a policy perspective, I think Trump is hurting his own case with the protectionism. I think that's weighing on the economy.
So how much worse can it get if these policies stay in place? We've already got additional tariffs that went into effect on September 1st, potential for talks with the Chinese in October, and yet there is still another round of tariffs looming in December.
It's not just the fight with China. You also have Trump in the background holding out the threat of levying tariffs on foreign automobiles, even with some of the most friendly nations we have, like the countries of the European Union, Japan. Trump is simply a protectionist, and we saw in the 1930s that doesn't work very well. So I'm not surprised that investors are a little bit nervous about what's going to happen.
So let's flip that question then. I mean, if you think that that is what's weighing on the economy right now, how much better do you think the numbers would be if it weren't for some of these trade policies in place?
What's amusing about all this is that the president himself said the market would be up much higher if it wasn't for his trade wars. Would it be up 2,000 points, 5,000 points? I have no idea. If I knew the answers to those questions, I'd be a billionaire living in the Cayman Islands. But I do know that protectionism doesn't work, and Trump is hurting his own case for 2020 with these policies.
When you look at the global macro picture, of course, the U.S. not the only concern right now. We've got what's playing out over in Europe, especially over the U.K., with no real resolution in sight on the Brexit front. I wonder, when you look globally and you look at some of the risks that are weighing on the overall outlook, where does Brexit rank?
Brexit is probably more of a threat to the European Union than it is to the United Kingdom. The United Kingdom, they made the choice to leave because they saw the European Union as a slowly sinking ship because of just a lot of statist policy, bad demographics. And yeah, getting out will be a little bit painful for the UK, but given all the size of the UK economy and all the products it buys from Europe, I think it's a greater threat to Europe. You have a lot of countries like Germany, Italy, that are on the knife edge of an economic downturn. And what's unfortunate about this is that Brussels, the head of the European Union, the headquarters, they have not wanted to strike a deal with the United Kingdom because they have their nose out of joint because they're angry that the British people voted for self-government.
Let's talk about where this leaves the central banks. Of course, the ECB will be meeting on September 12th. We are expecting some kind of stimulative policy on that front, whether that's an additional cut or the restart of its bond buying program. You've got the Fed several days after that. And on that front, we did hear from Jay Powell today saying that, look, the economy is in a good spot right now, but the uncertainty around trade policy is forcing companies to hold back. What are you seeing in the numbers on that front?
first thing is I don't think that central banks are going to be the key to economic growth. When they try the easy money policies, the quantitative easings, and all these different things, it's like pushing on a string. They can flood more money into the system, but if investors don't think there are good things to invest in, if there aren't good opportunities to create new jobs, build new factories, that money's just going to sit on the sidelines. In other words, I think it's more important for European countries, the US, the UK, every country, it's more important to focus on what is good policy. Get tax rates down, deregulate, focus on the real economy, not the monetary policy. That's a crutch that a lot of countries have been using.
Yeah, it's interesting you point that out. Jay Powell also mentioning that over in his comments in Zurich, saying that, look, central banks have less leverage to support the economy should a downturn come. Just look at what's happening in Japan. Just look at what's happening in Europe. Given that these trade policies are likely to stay in place, at least for now, what are the levers that can be pulled here in the U.S.?
Well, first thing that Trump should do is stop the trade war. That's kind of obvious. But then also, he's been a big spender. He's increased government spending faster than Obama did. Now, that's a long-run issue that sort of slowly saps the economy's vitality, so I don't view it as a business cycle type thing. I do give Trump credit for lowering the corporate tax rate. His deregulatory policies have been reasonably good. But I do worry that not only does he have the protectionism, but he's also bashing the Fed. I don't think bashing the Fed is a productive policy because you shouldn't expect the central bank to bail you out when you're causing problems with your trade policy.
Dan Mitchell, good to talk to you.
Thank you.